Good afternoon, everybody. Hopefully you can hear me. Welcome to Buying a Property Through a Company, our latest webinar. So the purpose of today is to go through all the reasons why that you might not be thinking about if you're looking at using the company vehicle for purchasing property. So for those of you that don't know me, I'll just start off with a little introduction of who I am. Bear with me. So, who are CCF Accountancy? So we're accountants and tax advisors based in Harrogate. I'm Teresa Bowe. I'm the managing director, and I'm the tax advisor here. So we're based in Harrogate, but we do have countrywide coverage with the furthest south client in Sandwich and the furthest east over in Anglesey. So we do cover all corners of the UK and beyond. And we work predominantly with growing businesses in all sectors, a lot of consultancy clients. We have an awful lot of IFAs, and we're doing an increasing volume of work with investors. And there's a picture of me in case you don't know what I look like. So the purpose of today, we are going to cover considerations before using a company. I'm sorry, going to bombard you with numbers because the tax considerations are the biggest reason for looking at using a company. So income tax, capital gains tax, the implications on property development companies, and we'll just finish off with a summary. So what I'd like you to do is please do interact with me. Obviously I'm doing this in webinar format, so you can't see each other's faces, but it would be good if you do have any questions, don't save them till the end. If you use the Q&A box, which is in your control panel, and then we can deal with the questions as they arise rather than leave them until the end. So without further ado, we'll start off on the considerations before using a company. So the first thing to bear in mind is the fact that the company is a separate legal entity. So if you're buying a property personally, you own the property, but it's your property, you can do with what you like. Whereas when you buy a property through a company, you've got you and you've got the company here, and you own the company and you can direct the company by being a director, and you can profit from the company by drawing the profit as a dividend, but the company is always separate to you as an individual. And that's what's helpful in order to help save your taxes, because the company will pay tax at the corporation tax rate, which is not related at all to whatever your personal rate of tax is. So we'll go over the tax in detail. That's what accounts for the bulk of the conversation webinar today. The next consideration, and I press this home very strongly to all clients, is the discipline that you do need if you are looking at using a limited company. Now, the reason for this is that I've already told you that the limited company is a separate legal entity, so it's almost like a person in its own right. The company has to have its own bank account. It's the company that enters into contracts, not you. So you can't use the bank account willy-nilly like you might use your own personal bank account. It's only company transactions that go through that account. You need to document everything because you will have year-end accounts, and just make sure that you do have that separation of company, you. So the company's transactions go through the company, your personal transactions do not. So using a limited company for property, or using a company for anything, there are going to be additional costs that you might not have as an individual. So the first on the list, bank charges. It's one of the biggest beefs people have with companies, is that they do have to pay a fee to the bank for using the account. Anywhere from, I think the lowest I tend to see is about £6 a month, anything up to 20-something pounds. So it entirely depends on the bank that you're using. When it comes to mortgaging, they sometimes, I don't know if it's a case of every time, but there's always going to be a setup cost for the mortgage, but the interest rates may not be quite as favourable for lending to a limited company as there would be for lending to an individual. And that's one of the many things that you would want to weigh up when you're looking at buying property through a company. I've put accountancy because wanting to be above the line and make sure things are clear, that accountancy costs are higher for a limited company than for a sole trade tax return, because there's more work involved. You've got a statutory set of accounts to prepare that's got to be balanced, filed with Companies House, corporation tax return filed with HMRC. So there is more work involved from that side of things. Capital gains tax, that can be more expensive, but it depends as well on the whole situation, which hopefully I shall explain in a way that you can make sense to you. But yeah, capital gains tax can be more expensive, but you've got to weigh it up against a lot of other factors. And stamp duty. So stamp duty, you will always pay the extra 3% when buying property through a company. If you're buying property over 500,000, the stamp duty rate is 15% for a company, full stop. So yeah, that's one thing to be aware of. The other consideration, big consideration that we will be going through, is the opportunity to save tax. So one thing that we always look at, and it's standard planning, not just for an investment property company, but for a trading company as well, is looking at other tax allowances available in the household. So how many people can we have as shareholders within the household to use up their basic rate tax band? And most importantly, the length of the investment. So we're always going to look at how long you're planning on holding the property, and looking at the what if scenarios in case that, what if you did plan, end up having to sell the property sooner than you planned, you might end up having paid more tax than you should have done, or you could have done. So that's something that we need to consider. And then the risk of tax rate changes. So way back 12, 13 years ago, maybe, when I was young accountant learning my skills, there were two corporation tax rates. There was the trading company rate and there was the investment company rate. So at the time, investment companies were paying 30% corporation tax, whereas at the minute, all companies pay 19%. So we don't know what the future tax rates are going to be. And I'm telling people a lot at the minute because of the coronavirus situation and all the government handouts that we've had, which have been fantastic and helped businesses massively. Brain's gone blank. The government are going to want to get that money back some way, and that will be looking at additional taxes in the future. And I think that the easy one that they may be looking at is investment companies. So that's something always to have at the back of the mind, what if the tax rate changes? So moving on to next slide. So just the headline rates and allowances, just so you're probably all familiar with them, but I'll go through them for those of you that maybe aren't. So current tax year, so 2021, everything I'm talking about today is based on the current tax rates for the 2021 tax year, and that's the tax return that will be getting filed by the 31st of January 2022. So the personal tax-free allowance that you can earn through trading, investment, whatever, is £12,500 before you pay any tax. After that, the basic rate of tax is 20%. So total earnings up to £50,000 are 20%. Above 50,000, it's 40% until it gets to 150,000, and then the tax rate goes up to 15%. But be mindful as well that income over £100,000 is an awful rate where, because you lose your personal allowance on income over between £100,000 and £125,000. So the effective rate of tax at that, taking into account the lost allowance, is about 65%. So if we have people earning between 100 and 125,000, that's always a really key one for looking at the limited company option. So, and apologies, I've just had a slide failure, but the other rate to talk about is a corporation tax rate, which is 19% at the minute. So there was word about it coming down to 17%, but that was revoked in the last update from the Chancellor, the last budget. So the capital gains tax rates. So capital gains tax is a tax you pay when you dispose of an asset such as a property. So the annual exemption is £12,300. So every year you can make gains of £12,300 before you've got capital gains tax to pay. And you'll pay that on property at either 18% or 28%, depending on whether you're a basic rate or a higher rate taxpayer. And I've got some examples to go through with you later on that. And then, oh, there's my corporation tax rate, apologies, 19% on the corporation tax. So the first thing we're going to look at from the tax point of view, because as I say, the biggest driver of this is tax, is looking at buying a property with a mortgage. So I've got a couple of examples to go through with you so you can see the differences. So in the first example, we've got a basic rate taxpayer who's earning £20,000 a year from their job. So they've got a property, and I've just done a little summary profit and loss account for this property. So during the year, they've had £10,000 of rents, and they've got total costs of that property of £6,000. So repairs, administration, accountancy, and mortgage interest. So typical of what you'd expect to see for a standard rental property profit and loss account. So the total profit for the year is £4,000. So this person on 20,000, they're well within their basic rate tax band. So they're just going to pay tax at 20%. So that's £800 tax they're going to pay on that. So the next example, we've got a higher rate taxpayer. Now the higher rate taxpayer is earning £50,000 a year from their job. They've got exactly the same rental profit as the previous one, £4,000. But because they're a higher rate taxpayer, they're going to be restricted on the amount of tax relief they get on the interest. Now, I've simplified this massively because it's for the purposes of the webinar today. There are other factors to take into account, but I'm not going to bore you with them. But their restriction, they can only get tax relief at the basic rate for their interest. So what happens is their taxable profit goes from £4,000 to £6,750. So because they're a higher rate taxpayer, they're going to be paying tax at 40%. So that's £2,700 in tax on that same property for a higher rate taxpayer. So there's other things that we'd also want to take into account for this higher rate taxpayer, which would increase their tax bill further. Well, apart the student loan repayment, that would also affect the basic rate taxpayer. So if you do have a student loan and you've got a rental property, then the profit that you're making on that property will get taken into account when calculating the student loan repayments. And then for the higher rate taxpayer, or even a basic rate taxpayer that gets pushed into the higher rate because of owning that property, they're likely to lose out on the child benefit if they're receiving it because of the high income child benefit charge. So next, so same property, we're going to look at the company tax position. So at the minute we're just focusing on income tax, and we'll go on to capital a little bit later. So same company, rent received of £10,000, the administration costs of the same apart from the accountancy. So I've put the accountancy to £500 I mean, that's what we typically charge for a property investment company. So the total costs in this company are going to be 6,300 compared to 6,000 when it was in the personal name. So the profit here is £3,700. So the corporation tax at 19% is going to be £703, but there's also the higher running costs to take into account. So assuming that the person running the company is going to take all of the profit out, they'd get £2,000 of the dividend tax free, assuming that they've got no other income from dividend elsewhere. And then they'd have tax to pay on the dividend. So the tax on a dividend is either going to be 7.5%, which is £75, or 32.5%, which is £324. So the total cost for a limited company, assuming that the taxpayer takes out all of the profit from the company, is either going to be £1,078, which is obviously higher than the basic rate taxpayer would have paid if they'd had the property in their own name, or it's going to be £1,327 for the higher rate taxpayer, which is obviously significantly lower than what they would have paid if they'd had the property in their own name. So just a summary where we've got to so far. So buying a property with a mortgage, if you're basic rate taxpayer, buy personally. So we've seen that it's going to cost you more money having that property through a limited company. If you're a higher rate taxpayer, and well, even if you are drawing out profit, the company option is interesting there because there is a tax saving to be had. But the one thing that you will want to think about is what might change in the future. So, for example, if you increase your portfolio from just the one property and you grow it to have a half a dozen properties, you may become a higher rate taxpayer in the future. Future tax rate changes, either personally or corporate, need taken into account. And the other thing is job changes, and it's quite relevant at the minute, but you know, is it going to be a permanent job change in terms of you're looking at scaling back, going part-time in order to fulfil your property investor dreams, or you're looking at retiring, you're looking at going from part-time to full-time because the kids are growing up. So there's a lot of factors to take into account before you buy the property that might affect what the tax is going to be in the future. So next. So we've looked at buying a property with borrowings. So the next factor is buying the property without any borrowings. So sticking with the same example of £10,000 rent. So there's no mortgage here. So as an individual, there's a profit, same costs as before, but no mortgage interest. So we're going to have a £9,500 profit on this property. So very simply, basic rate taxpayer, tax at 20%, £1,900, or the higher rate taxpayer, tax at 40%, £3,800. So in the case of the limited company, the company profit is going to be slightly lower because it's got the higher administration costs. So we're looking at corporation tax of £1,748 plus the additional costs. So the total cost for the company is £2,048. So again, the basic rate taxpayer is slightly cheaper, not massively. So if you're not borrowing, you know, the consideration is going to be what we said on the last slide. What is the situation now, but what is the situation going to be in the future? And looking at future-proofing yourself. But for the higher rate taxpayer, quite clearly, there's nearly 1,800 reasons why to look at company. So I'm going to move on to capital gains tax because it is a really key factor. Now, feel free to jump in and fire any questions as we go through this. There's a lot of numbers that I'm throwing about, and I go through numbers, you know, very, very quickly. So if you want me to slow down or repeat, just use the Q&A box in the control panel to let me know if you want me to repeat anything. So we've got an example here of a property that was bought for £100,000 in 2010, and it's been sold for £200,000 in 2020. So nice and easy figures. We've got a profit of £100,000. So the tax paid by the £20,000 earner, they're looking at a gain of £100,000, and they've got their annual exemption of £12,300 from the capital gain. So their taxable gain is £87,700. Now this gain is going to be putting them into the higher rate. So part of the gain, so £30,000 of the gain is going to be taxed at the basic rate, and £57,700 is going to be taxed at the higher rate. And we're getting taxed at the property rate of capital gains. So the normal rate of capital gains would either be 10% or 20%, basic or higher, but because it's property, there's an 8% extra tax charge. So the total, so there we go. So we've got £30,000, 18%, 57,000 at 28%. So the total capital gains tax that this person is going to have to pay is £21,500. So next, the gain for a higher rate taxpayer. So we've got the exact same numbers as before. The capital gains tax, the higher rate earner still gets their annual exemption from capital gains, even though this is going to put them over the £100,000 income. So the whole of their gain is going to be taxed at 28%. So they're going to be paying £24,500 in tax. So £3,000 more than the basic rate taxpayer, basically. So next, we're going to look at the corporate capital gain. So the company still made the same profit on the property, £100,000, but they do not get an annual exemption. Really key point, and a lot of people forget. So that £12,300, it's an instant, minimum of £3,000 extra tax before even looking at the rest of the rates. So the tax that the company will pay is just 19% on the profit. So instantly you might think, well, that's 19,000 compared to 24,500 or 21,500 for the basic rate. So that's good. But the trouble is that you're going to want to get that money out of the company at some point. So in order to distribute the profit, there's going to be £81,000 profit left in that company. So 100,000 minus 19,000. So the first bit of dividend, £2,000 we can take out, and there's no tax on that. And the balance is going to be 25,675 if you're taking all that profit out. So 25 plus 19, £46,000 in tax compared to £24,000 the higher rate, 21,000 for the basic rate. So it's quite a big difference, and it's a thing that a lot of people don't think about. So one of the things is, though, I've talked about you wanting to take all your money out of the company. It might be that you don't actually want to take the money out of the company. You might be wanting to use it for something else within the company structure. You might want to be buying another property with it. It might be that you've cashed in the property because you're retired and you're looking at drawing that profit out over the next 10 years as a pension. So there's a lot of things to think about. In my case, in my experience, what I see clients doing, it's very unusual for them to, want to strip out all the profit from the company. But no one person is the same. So the summary so far on the capital gains. So it's slightly higher on the higher rate taxpayer compared to basic. It's not, the difference isn't quite as massive as the personal tax situation. It is potentially lower tax for the company if the funds aren't going to be drawn out immediately. But if you are going to be stripping out all the company money in one go, then it's going to be looking quite expensive. So one option is members voluntary liquidation. So this is where a company, it might be that it's had a portfolio over the years, and this 100,000 was the last bit of profit in the company. So you could be looking at the MVL as a way of taking out the profit from the company, not paying tax, dividend tax on that, and taking it out, paying capital gains tax instead. So we've got the profit that's sat in the company, which is £81,000. So that was £100,000, but then it's had to pay capital corporation tax of 19%. So this is the individual's point of view, because it's the individual taking the money from the company. So the individual has got their annual exemption of £12,300 as before, leaving £68,700 subject to tax. There's going to be the liquidator's fees. Now, them liquidator fees probably paid for out the company, to be fair, not out of the individual's pockets. But either way, the individual is going to get £2,000 less in their pocket. So that would be leaving £66,700 subject to tax. So because they're winding up the company and taking it out as capital, assuming this is a higher rate taxpayer, they're going to be paying tax at 20% on the capital gain. Now, for those of you that know tax, you might be thinking, well, actually, why aren't we getting entrepreneurs relief at 10% instead? Why are we paying tax at 20%? And it's because you get entrepreneurs relief on a trading company and a property company, unless it's a development company. A property investment company is not a trading company, so you don't get your entrepreneurs relief. So the total cost for the company on that £100,000 profit, £19,000 corporation tax. My estimate of liquidators fees are 2,000 because it's a reasonably simple liquidation. The capital gains tax on the individual of £13,340. So that's a total tax cost of 34,000. And again, harking back to what the company, the higher rate person was paying, they were paying £24,500 tax on the gain. So there's still you know, not a lot of interest in using the company when you're going to get hammered on the capital gain. But what about the lifetime savings? So in this example, just of one property, over 10 years, the higher rate tax saving that was achieved per annum on this property was £1,373. So we'll multiply that over 10 years. So over 10 years, they've saved nearly £14,000 in tax, compared to the extra capital gains tax that you'd be paying between the higher rate taxpayer and the company. It's an extra £9,744. So over the lifetime of that one property, there's a net £4,000 tax saving to be had. Now, one thing I find with clients, and no offence to any clients that are on the webinar today, is that they do tend to have short memories. I think it's a natural human response that when you do get hit with a large tax bill, sometimes you forget about all the small tax bills that you've had accrued over the years. So yeah, I think if you were making significant savings over the year, that they might pale into insignificance when you've got that extra capital gains tax. But when you look at it in black and white, you know, for the long term, there is a potential saving to be had. So there's other things to consider when you do come to sell. So number one, are you still going to be a higher rate taxpayer? Are you going to want all the money out in one go? So I've said that already. Are you going to be looking at drawing it out over the next 5 years, looking at paying tax at 7.5% instead of 32.5%, because that reduces the amount of, you know, the impact of the capital gain sale and drawing the money out from the company. And the other thing that we've not talked about, and I'm not going to go through that today with you because we don't have time on the call, but are there other factors to consider, such as other shareholders that you could have on the company to help reduce the tax that you're paying. So next, so property development. So when we're talking about property development, we're talking about buying, renovating and selling property. So it's a trade rather than an investment. So whereas your investment income in your personal tax return for renting the property out, it's just purely the tax that you're paying. Whereas if it's a trade, you're subject to the tax and the national insurance. So the tax rate obviously depends whether your basic rate or higher rate, which is the 20% or the 40%. And the national insurance is 9% for self-employed sole traders at the basic rate, and then at the higher rate it's 2% the national insurance that you pay. So I've got an example here that there's been a property development, somebody's bought a few properties or bought a bit of land and built some property, and they've made £100,000 profit. So assuming that this person had no other income in the year, they'd be looking at a tax bill of £27,500. And then on top of that, they've got the Class 4 National Insurance bill of £4,600. So total tax and national insurance on the property development of that level, we're looking at just shy of £33,000. So that leaves a profit after tax of just under £68,000. Now, in my experience, 9 times out of 10 for property developers, that money is going to go straight back into another property, because that's what you do. You buy, sell, do up, buy the next one, buy, sell. So I buy, do up, sell, get the next one, and so on. So in the case of the company tax on that £100,000 profit is going to be £19,000, which is leaving £81,000 for the property developer to reinvest into a property. So nearly £11,000, £11,000? No, it's more than that, about £13,000 extra in the kitty is going to go quite a way when it comes to looking at the next property. Okay, so the other consideration with property development, and I suppose it applies in some way towards sole traders, but there's usually more tax opportunities, tax saving opportunities for the company. The property development company is a trading company, and it can justify all the standard tax efficiencies that we would use for any company to save tax. So director salaries, and not just director salaries, but are there any personal allowances in the household that are going begging? So in the case of a family that are doing property development, if there's the conventional husband, wife, 2.4 children, once the children are over the age of 14, and if they're helping out on the weekend to, doing a bit of labouring on site, or whatever, health and safety permitting. So want to make sure that we're using all the personal allowances for salaries that we can do. Looking at pension contributions, because they are pretty much the #1 best way of saving tax, or safest and best way of saving tax at the minute. And I'm not talking about investments because that's not my area, but in terms of a justifiable tax deduction that HMRC won't question. So I've talked about employee and family. Employee gifts, and I always talk about employee gifts. One of my clients' favourite things to know that you can buy yourself 6 gifts of £50 a year, and it's fun. My favourite client ever bought herself a hairdryer as one of her gifts in the year. So corporate entertaining, obviously corporate entertaining is not tax deductible, but it does save people tax on dividends if they're putting that with the company. And a big one at the minute is tax efficient vehicles. So at the minute, if somebody bought a vehicle, a car or a van through the company, 100% tax write-off if it's electric, if it's 100% electric. And no benefit in kind tax on the directors if they're using that. Well, no benefit in kind tax for the first year. Year 2 it goes to 1%, and year 2 it goes to 2%. So that, you know, all that would be taken into account within a trading company. An element of it can be allowed for the sole trade, but there's more flexibility in the company there. So the final point, and it's one of the biggest points that would come across, is company to company lending. So what we have is a trading company that's got reserves sat on the balance sheet. They're not getting much interest from the banks because corporate lending, corporate deposits, you can find them, but they're few and far between. So the director, shareholder, owner is looking at, what can I do with £100,000? I know, I'm going to put it in property. So to draw that out as a dividend and to buy a property individually could cost potentially over £32,500 in dividend tax, which would leave you significantly less to put down as a deposit on the property. So what we look at is forming a new co. This is a company that's going to purchase a property. Now, one of the big questions people ask is, why do I need to set up a new company to buy the property? Why can't I just do it in the property, in the company that I've got? Well, one of the things is risk. So lenders look to having the property within a separate company because it's got a different risk profile to the trading company. So if something happens to the main trade, you know, as we can see with the coronavirus situation, you know, all the employees are furloughed, the trade's gone down the pan, there's nothing left, the company's going into administration, going to get wound up, you know, you can't pay the debts. So the bank are going to be, you know, potentially losing out big style. So they want that property in a separate limited company. They've got the security over that property. So if anything does go wrong, then they can call in the debt there. So the other reason is if you're looking at potentially selling your company, your trading company in the future, but you're wanting to keep the properties as your retirement pot, then it's so much easier that you've got it in the separate company rather than you've got it all together in the one pot that you'd have to pick apart and potentially transfer it into another company and paying stamp duty on that is a big no-no. So, so we form a new company. Now, these companies are referred to as SPVs, a special purpose vehicle. Just so you know, when you look at Companies House, there isn't actually a separate legal thing called an SPV. It's just a term that is used by the lenders to what they describe this separate company. So it's you know, it doesn't make any legal difference. There isn't a legal term called SPV. So the other thing when we're forming this company is we might be looking at being flexible on the shareholdings. So it could be with the current trading company. It was formed 20 years ago by Bob. He owned it himself. A little bit later, he got married and married to Sue, and she's never really been involved in the company. But Bob's now a high rate taxpayer. Sue is a basic rate taxpayer. She doesn't own any shares in that company, so he can't be getting any profit to her, because if he did, it'd be caught by the settlements legislation, which would mean that there's no tax benefit for Bob transferring his profits to Sue. So when we form a new company, we could look at putting some of the shares in Sue's name, so that when the company has bought the property, it's making a profit, we want them to get some dividend out, we can potentially put more profit in dividend in Sue's name, so that Bob's not paying the high rate tax. So a lot to think about when the company is formed. So then the trading company lends the new company £100,000. The new company buys the property, so it might be that £100,000 bought a house or two in Hull or South Shields or South Yorkshire, where the properties are lower priced, or it might be that that's a deposit on a property in Harrogate and they're going to make up the rest of the mortgage. But either way, the new company buys the property. And then the new company has got a debt on the balance sheet. It owes the trading company £100,000 and it can repay it as and when it chooses. Or if there is an agreement in place, so perhaps Bob has got another shareholder in place, Steve, and Steve wants to have some protection because they're not related. They're just two people that happen to run the company together. And it might be that they've got an agreement in place that when that new company is in profit, it might have to repay that debt to the existing company. But it can be flexible. It's your company, you can do what you like, provided you're not breaking the law. So, final summary. I was aiming to finish the main part at 1:45, so bang on time a minute. So looking at buying your property through the company, the opportunity is really for the higher rate taxpayers or people that might become a higher rate taxpayer in the future. You really need to be looking long term. So short-term decisions can be expensive, particularly if we're looking at the capital gains tax, which showed you in the example that in the long term, there is a net saving, even though that the company doesn't get the annual exemption from capital gains tax. So using a limited company to buy property is a really long-term plan, and I'm talking about minimum 10 years. So always be aware of the risk of tax policy changes. So one thing I do look at is splitting the risk. So I do have a lot of clients that maybe have got some properties in their own individual name and other properties within the limited company. And in some ways that can give you this extreme flexibility, because it could be that you've got property in your own name, you've got the limited company that's got some property, and you are a higher rate taxpayer and you don't really want this profit in your hands as a higher rate taxpayer. So the company could potentially charge you as a sole trader a management charge for looking after your properties, so that you can move some of your self-assessment profit into the company to save you tax at a higher rate. So lots of things to think about there. Beware of the need to release cash quickly. So that can be expensive. So always have a plan B. You know, what if something happened? What if we lost a job and we need to get our hands on cash? Do we have enough equity within the company that we can raise some cash, or personally we can raise the cash? Because you know, there's nothing worse than having a long-term investment strategy and then having to cash out early and lose all the benefit that you could have had of having that structure in place. Use the family allowances, and I'm obviously not talking about the family allowances that you used to get on the gyro from the post office. It's the personal tax allowances from other family members, so spouse, kids. I mean, I've got companies, I've got clients who've got companies that they've got grown-up children and they'll still have some shares in the name of the children to use their £2,000 dividend allowance that we currently have. So you know, there's a lot to think about. Obviously, when we're talking about shares in other people's names, we do look at an alphabet structure. So the alphabet structure is when you've got what we call alphabet shares. And so A shares, which are the normal shares that give you control of the company and entitlement to dividend, and then maybe B, C, D, E shares that give you an entitlement to dividend. And you don't have to declare a dividend on every type of share. And then last point is get advice before buying. So it's really easy to jump in, buy, and then ask questions later. It's a false economy. Get the advice up front, which I think most people would do over time. But there's nothing worse as an advisor when somebody comes in after they've set the process in place and it's too late to unwind it. So it's really, really key that you do that. So just to final point, how we can help. So we look at forming companies for clients. with the alphabet share structure that I've discussed for tax efficiency. Our costs for forming a company, including the advice beforehand, is £150 plus VAT. We do have some great value accounts options for people. We don't charge a massive amount for limited company property accounts because they are reasonably straightforward, and we can give templates so people can do the basics in order to keep the costs down. Obviously, we've got a knowledgeable team on hand for ad hoc queries, and we provide regular updates and easy to access support. So for the clients on the call, you'll see that we send out our MailChimp updates, and we put on events like this to help as well. So just to finish off, and please do chuck in any questions before we finish. Our next webinars are 26th of August, what your accounts say about you. I just had an embarrassing conversation with a potential client yesterday whose accountant had filed the wrong type of accounts. So they were a bit red-faced when they saw that their accounts were saying, look at me, I'm tiny, I'm a really tiny company. And that wasn't really the image that they wanted to present. Tax plan for IFAs, I would be really grateful if you do know an IFA. If you've enjoyed the talk today, if you do know an IFA, let them know about the webinars we're putting on, please, because that one's just for them. 6th of October, how to be tax efficient, and then the 20th of October, new business basics. So if you do know anybody that's looking, or if you're looking at forming a business, and we talk through all the considerations like should it be a sole trade, should it be a limited company. So just had a question. Okay, Gavin, yes, I shall cover that. Gavin's asked, can you include a brief discussion on pros and cons of moving currently personally owned properties into a company? So I will cover that off, and I'm sorry that I didn't include that in the talk. The main con is stamp duty. So there will be a stamp duty charge for you selling that property to the company, and potentially capital gains tax. It depends on how long you've owned that property, but you know, if you've got a friendly valuer who's going to value it at your original cost plus annual exemption from capital gains tax, the capital gains tax can possibly be avoided. So the main issue you're going to be looking at is the stamp duty and the legals doing it. So I would say, I mean, obviously the advantages are going to be the advantages that we've already talked about today in terms of for a higher rate taxpayer, the tax savings you're going to be looking at. But if you are thinking about moving your property into the company, my general position is no, don't do it. But if you're looking at growing your portfolio, then obviously if you do have that flexibility, if you've got one property in your personal account and then you've got another property within the company, then you've kind of got the best of both worlds, and that kind of helps you for future proofing against future changes. So yeah, that's my main view on that. Hope that answers your question. So if you don't have any more questions, speak now. I'm going to stay on for the next 2 to 3 minutes, see if any of you have got any questions that you want to fire across. And then if you would like a follow-up to the discussion today, please feel free to contact the office or email me, and we can set up a one-to-one, and we can talk that through with you if you like. So thank you for joining me. I hope you found it useful. As I say, drop me an email if you want to go through any further points, and I'll just hang on for the next few minutes.